Very pleased to welcome up Joe and Omeed. Thank you guys so much for joining us. Come on down, guys. Grab a seat here, and looks like you got the mics. Make sure those are all turned on and ready to go. Love for you guys to take a few minutes and just share a bit about your backgrounds. And so we met Joe and Omeed at the Newport Family Office Conference a few weeks back, and just kind of had a great connection right out of the gates. And they've worked with a large number, very high net worth family offices, as well as for hedge funds and other folks looking to access those markets. And one of the things they've concluded is that just it really takes that unique differentiation, that unique marketing. When we're at the angel level, it's one thing, but when we want to step up to that next level, we really need an upgrade. And that's a lot of what we do as angels, trying to translate the technology to a market. But when we look at companies in terms of capital raising, when you're talking about really talking to the big money, they want to make sure everything's dialed in from top to bottom. So very fortunate to have them with us here. They're going to talk about it on both sides of the equation, both as entrepreneurs looking to access family offices and raise capital, as well as how family offices can help to differentiate themselves in a way that provides co-investment and opportunities and such like that. So I'm going to turn it over to them, get us started for a few minutes. I'm going to take a quick break, and I'll be right back. Turn it over to you guys.
Is this on, or can you hear me?
How about me?
Yeah, I think so. Okay. Why don't you start?
Sure. Well, first of all, thanks to Nathan and Kretz, who, this is our first time here, and we've been really impressed with the content this morning. A lot of it has been informative for us and also kind of consistent with how we view the world and how we view the way it's evolving. I'll give you my background quickly. I was a former hedge fund manager. I spent the first 15, 16 years of my career as a hedge fund analyst, and then ultimately started a hedge fund. A few years ago, Omeed was building a hedge fund business at a very large bank, and hired me to join him and help him to create a hedge fund advisory business where we did a number of things. The reason we're talking about branding and differentiation today is because, as many of you are aware, the hedge fund business has become somewhat commoditized. It's not that there aren't great hedge funds, there's just so many of them. And so
there's actually more hedge funds than there are names in the S&P.
Right. So with that, I'll let Omeed introduce himself, and then we can maybe talk a little bit about.
Yeah, I'll work backwards. I ran and started our hedge fund advisory business at Bank of America. I was there for almost 7 years. Prior to that, I was a corporate lawyer at an international firm in New York. Most recently, I think that experience is relevant because one of the roles that I oversaw our international team was helping alternative asset managers raise capital. And what we observed was that the investors who were institutional demanded that, especially after a post-Madoff kind of environment. And we then had the hedge funds trying to become institutional. But what they lacked was an institutional intermediary. And that's the role that we had. So being at the nexus of that information, I found to be very valuable, what we were sitting on. And so it was our job to know anything from an endowment, foundation, sovereign wealth fund, all around the world, and the best stewards of that capital that were providing a high yield return that was also going to be uncorrelated to whatever else they had. And necessarily one of those types of investors were family offices. We spent a lot of time with them. And so now in our own business, we decided to present kind of what we're seeing going forward together in our new entity. And the format we wanted to do, because in full disclosure, one other commonality we have is we both started in politics. So he was at the White House when we met, and I was in the US Senate. So we thought we'd do more of a town hall style. So that's why we both have the microphones and we're sitting down and we'll stand up. And he has every right to interrupt me when I say something wrong. And so do you guys. If anyone has a question, we'll answer to make it more of an interactive session. So that applies to you too.
Given that it's lunchtime and everyone's been sitting for a long time, and we thought it would help it to make a little bit more lively and interactive. The last thing I'd say is that I think the reason Nathan asked us to be here and the reason it's really appropriate is, as we've taken on more clients in our respective capacities in different businesses, what we've seen is something Bill Payne was talking about earlier. I think he said 20 hours of minimum investment time, due diligence, 12 deals, you need to be diversified. So that's 240 hours, and you're also probably doing it part-time. So you need to be co-investing, and that's become the in vogue concept specifically for family offices. But how do you co-invest well? How do you pick the right partners? And at the same time, we're seeing our client base evolve many private companies as opposed to your traditional hedge funds. So that is something we're spending quite a bit more time on as of late, and into helping family offices define how they should be part of a unique group of an investor class, and then what product they have to invest and choose from.
Yeah, so I mean, the catalyst is you've got a very interesting thing going on in the hedge fund industry. Assets are at $3 trillion, so they're a record high, but at the same time, everyone here knows it's a very maligned sector for investors. So it's very unusual that you have that dichotomy, but what's really happening is that the big are getting bigger, and the kind of moderate sized firms where you're getting most of that juice in what's still a nascent industry are really struggling. And so we have basically distilled in that industry who we think the creme de la creme is. We provide that as an extension of our investors' portfolio. We do the same thing with private equity, and now in partnership with Nathan, we're doing the same thing for pre-IPO companies. That's how this evolved, and the structure we're going to be doing that in is in a broker-dealer structure, where we're going to be able to do that not only through providing trading solutions, co-investments, as you pointed out, but also advisory on smaller kind of mergers and acquisitions across the space that you're talking about. So in that respect, this is a very exciting opportunity for us, really early stage to talk to all of you, because I think we're firmly in what was labeled the Death Valley stage of a company.
Right.
So hopefully we're going to emerge from that. But I guess, just by a show of hands, how many people here have exposure to the alternatives asset class, hedge funds or private equity? Right there with the pencil. Are you satisfied with that exposure? Well, I mean, the biggest struggle that we see with that is, especially what's happened since the crisis. Obviously, you can see how they've lagged overall S&P returns, and yet they're charging, which was 2 and 20. You're having a massive correction in that industry right now that we're going through in real time. Let me be very clear, I don't think it's an existential threat to the asset class, but it is not going to be the same ever again. So when you have that many hedge funds, you're going to have some social Darwinism. And that's why you're seeing the amount of hedge fund closures. And also the incentives have to be realigned. So when it was, again, as I mentioned, an earlier stage nascent industry, it was okay to charge 2% just for waking up. That gig is over, okay? I mean, really, it's kind of funny, but that actually was a business model. So they were incentivized just to grow assets, and when the market turned the way that it did, you know, you're not supposed to be paying 2 and 20 for a 2 or 3% return. So that is where the fee compression is coming from, and that is another reason why anyone who's over 55 and a multi-billionaire has now shut down their firm. So this presents a very interesting opportunity for where those assets, as I mentioned, $3 trillion, are going to be reallocated. And it's not just going to go back to hedge funds. So that's where we are trying to advise those investors that we represent as to where that's going to go. And a lot of it, I think, is going to be in some of these more uncorrelated opportunities that you're working on. So I want to just use that as a segue, and again, interrupt us any. How do you help that company that was able to get that angel investment to then get to that next level? Now, a lot of the principles we used in helping some of the hedge funds that you know go from a nobody to a brand name is scarcity. So do you want to talk a little about that as a concept for us?
Sure. There's typically two things that need to take place in order for someone to make an investment into an alternative asset. One is that it has to be something that is relatively unique, that they think they have an opportunity to do. And the second is they have to have a reason to do it now. And those are some of the hardest things to create when trying to, close, so to speak, an investor. Now, as angel companies, whether I remember Bill Payne's graph, regardless of whether they're leaving friends and family and it's before venture capitalists come in, there's that group where you have typically an innovator, an entrepreneur with a great idea, maybe a product, maybe it's pre-revenue, maybe it's post-revenue, but they've never been selling it to institutionalized investors. And family office communities are becoming far more institutional in their practices. They're doing more due diligence together. They're sourcing deals together. And so the very people that are trying to get their money are not as sophisticated as maybe the other entities, like a 15-year-old hedge fund might be, in explaining why they have a good product. At the same time, the family offices are struggling to see good deal flow. They see a lot of deal flow, but you know, drinking through a fire hose as opposed to a fountain may not be the best way to find the best deals.
It's the return on time concept as well.
Exactly.
From your seat. So scarcity plus return on time are two of the elements that we stress, and we hope that, you know, we're providing a solution for. I just think that I started with the hedge fund example. I'm just going to go back to one point. Yes, writ large, it's struggling, but I want to be very clear. There are still funds that are charging 3 and 30. So
And closed. They won't.
let you in.
Yeah.
Right. So I think the other thing for investors of capital in this audience, whether you're a family office that's already formed or you're an investor who's doing this part-time, is how do I get into that? And a lot of that then is what this title is, just creating a distinct brand and unique differentiation, not just as someone who is soliciting capital, but someone that wants to get into a deal as well. Because the people that have kind of the choice to what kind of capital they want to take, they are looking for certain attributes in an investor. And so that's, again, the intelligence that we're trying to provide on both sides of the ledger.
I think it's great to have you guys here providing that perspective. You guys have been in New York, you guys have been to the money centers, you guys understand what's happening in those capital markets. We don't get that here in Seattle. We're the backwater, you know, we're where they come and siphon off all the wealth, take it back, and, you know, maybe they'll reinvest it back here at some point in the future if we grovel enough. So we'd like to change that paradigm. You know, we'd like to go direct. You know, we want to make sure our investors are in fact more sophisticated, so that as they're backing companies, they've got it's not just, you know, Joe Angel or Susan, it's actually a little bit more of an organized, you know, effort in terms of who the investors are that are backing these companies. We think that is a helpful component. And then as we learn how to, you know, talk to Wall Street, look at building a network of family offices that want to co-invest and ultimately create liquidity. So I think, you know, help us understand a little bit about how you see family offices that want to go direct, you know, being involved, you know, partnering with angels or other organizations like this, and then also then upstream, you know, look at, you know, where is the investment banking market today? You guys are looking to organize yourself in that kind of capacity, and that's one way to do things. But, you know, generally Goldman Sachs isn't coming out here and talking to us. So, you know, how do we access the bankers who do want to talk to us and be able to have those go-betweens? Because that's, I think, very valuable to create that liquidity for the angel community and for everybody to really make it sustainable.
I think you're starting to do it because it's strength in numbers. It's exactly forums like this that get people like us to get on a plane from New York and come out here and try to learn, because we're learning from you guys in the same way. There's an enormous amount of wealth here, but it starts with also that branding of you guys as an epicenter that people need to make sure is a stop. I think it's starting to happen. I mean, I'll just share an interesting anecdote. I sat on the flight over here, and full disclosure, this is my first trip to the region. And is it okay to call it a region? I think so. Right? Yeah, okay, cool.
Pacific Northwest.
Okay, well, you're originally from here, so yeah, you get to say it. Okay. Sorry. And sitting across from me was my neighbor in my apartment building, who lives right below me, coming out here for business. And neither has ever been here before. So I know it's an anecdote, but I do think that it maybe is instructive in a way. What other kind of more of the regions have done that have strong family office networks, and I'm thinking Dallas, in particular in Texas, they have really put themselves on the map because their family office community has gone together. And when we were doing, a lot of what we do is we take the product, whether it's a hedge fund manager, a private equity manager, or a new deal, and we bring that principle to the region. Dallas was always a stop. I don't care if it was Bill Ackman or any of the guys that we represented, we were taking him there. In the same way you saw that happen in Hong Kong, because of the demographic shifts that happened in China, you're seeing now an enormous amount of first-generation wealth in Hong Kong that also became a stop for me with all of my clients. And it is these kinds of forums that start getting that word of mouth out there. And it's why we're excited to be partnering with you to make sure that we have this kind of bi-coastal relationship to start bringing product out here. And the more that you guys join forces, I think the more relevant you're going to be, not only to mitigate the diligence that you're talking about, but also being able to get access, because that's part of that, to that product that's differentiated.
Well, and Nathan, just so you know, I drove here. I've had my kids with my parents in Portland for the last 2 weeks, so I'm happy to be back, and I'm back often. And I actually spent a lot of time in San Francisco during my previous hedge fund life. That's where my firm was based. I think that people forget about the West Coast when they're on the East Coast because it's further to get out here. I think that it's also younger in its family office community. I think the Hogan family this morning was a perfect example. I think everything they're doing is exactly right, exactly as it should be. It looks much more institutional than typical family offices that are that young in their life cycle. And they even had a little box, a little tiny one, for direct and co-invest as they begin to build out that aspect of their portfolio. But if they are an example of 15 or 20 or 50 more like it in the Pacific Northwest and as we move down the West Coast, then as sophisticated entities like that continue to interact with each other, and as Bill Payne said earlier, you know, you share in others' deals and they share in yours, provided you have good sourcing, the industry grows naturally on its own. I mean, we've seen the same thing in Minneapolis, where many of the family offices there have grown and become more sophisticated, partnered with multifamily offices, and they're starting to bring in product that typically they didn't get to see before.
There's a meeting of the minds, though, because the product wants to get out of that New York tri-state area. It's so overbrokered and oversaturated, so we actually do see a real desire to diversify their relationships geographically. So I do think the demand on the other side is there as well.
All right, we'll open it up for questions. So I know we've got a couple mic runners here, and we'll try and make sure we keep it as lively as we can here for the next 15 minutes. So go ahead.
Really quick for us, we had a family exit a while back, substantial amount of years ago, and we are now in our kind of nuclear family, building a family office. But what I'm hearing from you is that we need to actually be thinking about, because basically we are as a mini fund, right? Like we came from a real estate, that's all cash, and we're essentially a fund. So what I'm hearing from you is that we need to be thinking about how we're represented to other institutions and as a broader thing. Now, we're kind of a blank canvas. We're doing a lot of things with our own personal values, and it's very altruistic. We're not adding, in my view, a commercial layer where we're saying, how do we want to be viewed by a bank that's approaching us? How much or how, I mean, the Hogan thing was wonderful, but that looked like it was, I'm sure compared to other family offices we're seeing that might not have a website or things like that, but at the same time, that website didn't have we're looking for this kind of thing. They put a really nice, eloquent kind of layer on top, but should we be thinking about, like, positioning ourselves in the...
You have to. I know you're passionate, but... okay. So, I mean, that, if you don't take anything else away from this, for someone in your seat, is the point of our presentation. That despite being the person with the money that you think is constantly going to be solicited, you have to be thinking about the way that you are perceived by the street and potential LPs or other or investments that you're going to make, because they are being saturated, if they're good, by a lot of people. And so it's not that cash is king in every example. So one of the things that we're trying to do is to help you understand what your values are, what your goals are, and package that. There is an element of kind of communications and PR, for lack of a better phrase, but not the way that it's conventionally connotated, that goes into all of this. And we have seen that pay massive dividends. So a lot of it is understanding, but it's curated. It's not like anything else where it's just spaghetti. Let's just try to create a website and get a LinkedIn page and therefore it's going to happen. Absolutely not, because then you'll get kind of what you pay for.
Well, and I want to distinguish between branding and marketing and sales and a much larger point, which is you now have a business. Now that business is X dollars of cash, and you have solicitors of that cash, and you have to decide what to do with it. Now, if you want to divide it up and say we're going to pick a bunch of different things that we're passionate about, that's fine. But I would recommend treating it like a business and say, all right, how are we going to allocate this capital? What is our new portfolio? Whatever we exited, what is our new business now? How much are we going to have towards angel? How much are we going to have in traditional alternatives? How much are we going to give to the financial advisor? Are they actually worthy of receiving this amount of capital? Can we do it on our own? Do we want to hire somebody? Do we want to outsource deal flow? Do we want to hire a former Goldman Sachs banker to come in and give us ideas? Like, put a plan together. That goes without saying. What we're trying to communicate is, once you have that plan and once you have that infrastructure, talk about it. Come to places like this. Talk about doing deals together. Go to, we were at the Opal family office event in Rhode Island, and there were very few family offices from the West Coast that were there. And there were, frankly, very few hedge fund managers that were investment worthy, but it was an unbelievable networking opportunity for other family offices. But if you go in and you say, hey, we've got all this cash, we don't know what to do with it, you're not considered serious by an entity that says, well, we've got a system in place, and this is how we're handling these types of investment, and this is how we're handling others.
I think it'd be great for you guys to talk for a minute. The Northwest here, we're blessed with incredible wealth. It's really been a philanthropic community in the way that a lot of the families have organized themselves. AIDS Foundation, Allen, and on down the list. There's 70,000 nonprofits here. We are blessed to have no income tax here in the state of Washington, so you guys are welcome to relocate here anytime.
I didn't realize that, but that is a very, very material point. Thank you for sharing. We'll get you the real estate guys. Can we talk afterwards?
But we come from that culture whereby you exit and then you set up your nonprofit, and that's kind of become your family office, and you're doing your philanthropy. But we've had a tough time breaking through to that group to get them to come over to the investing side of the equation. So any thoughts just on kind of your guys' experience in terms, philanthropy needs to be a part of it, but there's these other parts that are really important to our business community and being able to make sure we're investing and not just, donating.
Every one of those guys that we were talking about, that the billionaire hedge fund guys, have a separate family office run by a professional. Okay? And yes, philanthropy is a part of that portfolio, but it's only one piece of it. We had, about 12 of them the other night at dinner in New York?
And I would say that if you really love philanthropy and your ability to do it, make sure that you're generating enough return with your other portfolio that you can continue to make these types of philanthropic investments. And I think that many of the very large family offices that we come across, and not necessarily just in New York, but they're mainly in the New York, Boston area, are hypersensitive to that. If they want to make 7 or 8 or 9% annual contribution, then they need to be making sure that the other assets are generating that type of return, or the spigot runs out.
Yeah, and I like the other question you were asking about how do you, and a lot of these questions have surrounded, get kind of access to that investment banking or Wall Street. Yeah, you don't need Goldman Sachs or my ex-employer or any of that stuff, because quite frankly, they're not the right solution. They are way too big. And so you're not going to get what you require in this room, which is some of what you're offering, which is that curation. That is everything, because it provides you that return on time, and you're getting a germane piece of advice, not something that is one size fits all, which is all you can do with size in that regard. So that is why we think that this broker-dealer model, that we are trying to fill that gap to address that mid and small cap market of investors that are not getting the product they want, and quite frankly, to help the solutions of themselves diversify their underlying investor base. Again, we see a demand on both sides of the ledger, and that's creating the catalyst for why we're doing this.
And don't forget that you are in the absolute sweet spot for creating outsized returns with uncorrelated, that's not correlated to the market, because of your size. If you're making $100,000 or $500,000 or even $50,000 investments, and you can make them quickly, the number of opportunities that will become available to you as a result of that are tenfold what a much larger institution is. We see all the time, we see clients come in and they're offered an opportunity to bridge something for 3 months, and they get 30% on their money, and if their CIO and their team can get comfortable that those assets are somewhat secured, or that the risk reward is an investment they want to make, then they can go ahead and write that check. And even a regional bank can't move that quickly. And so you find yourself seeing opportunities, provided that you're getting enough flow, that because of your size and because of your nimbleness, you have an opportunity to make a really outsized return.
Yeah, I mean, you met the client that was doing bridge loans when we were out in Newport, 6-month duration on a 12% return, because exactly they're filling the gap that isn't there. Yeah, I think it's out there.
About 5 minutes left here for any other questions for Omeed. Do we have any other questions? Go ahead, Dan.
You talked about the cost of hedge fund management in terms of 2 plus 20 and variety. Where's that headed? In other words, there's got to be something. And are they going to start giving it away, or who are the up and comers?
There are some hedge fund managers trading for food right now on Madison Avenue. So actually, if you take them out to lunch, they'll do it. I'm being facetious, but it has gotten that bad for some of them. You think about it, like just look at the average returns. Now, with that said, that's like saying all restaurants stink. And for some reason, we looked at hedge funds just as a restaurant. So I hate hedge funds. Okay, so I hate restaurants. But there is a difference between McDonald's and a high-end restaurant. But no one was really thinking about that. So you get what you pay for. So for the people that are putting up the middling returns, yes, there will be a new price associated with them. On the aggregate, though, 2 and 20 has become 1.5 and 15 at the most. So there is a new normal. But with that said, to the extent that they are delivering on what they say they're going to do, you can charge with what you want. And there are plenty of behemoths out there who are doing so. But again, the most important thing that's going to happen is not really about the fees, because that misses the broader point, is that they are going to be eliminated. Because if you can't deliver, you will no longer exist. And that hasn't happened yet in that industry, and it's happening right now as we speak. So you cannot have more options of hedge funds than you do of stocks to invest in. It was a racket in some regards, and too many people entered. It's like every other bubble, and it's bursting.
And I would just piggyback. The problem, again, isn't the fees. It's that there are too many of them, and they aren't generating the type of returns that you would expect for that type of investment. It was similar to the restaurant analogy as an angel investor.
What do you invest in with $10 billion under management? How do you? Okay, so you invest in FANG, right? And so anybody else can get that access themselves, and they don't have to pay the fees. That's the big.
And as a family office, as you're thinking about whether it's an angel investment all the way up through maybe an emerging hedge fund, the fees that they can get are the fees that they will get, and you can start to demand things as a result of it. As it relates to hedge funds, you're seeing a lot more revenue shares. You're seeing a lot more equity stakes for new funds in particular. But it's an eBay market, right? Funds get the fees that they can get, and if you'll pay it, they'll take it. And if you won't, they won't. And if enough people won't pay low enough fees, the hedge fund doesn't start. Always be wary of a hedge fund, since we're talking about those, that's offering 0% management fee and 10% performance fee. That means no one wants to give them any money. That's not a good place to start.
Fees are part of their brand. And that's what everybody should be thinking about, because the terms that you go in with, it's the same thing for an investor. What we always say is, what's the duration of this capital? I would always say to my client, are they someone that's going to only be in quarterly, and the moment you have a down month, they're going to redeem? We don't care that they'll pay the full fees. Don't take the money. So that is analysis that's going on the other side of the table every step of the way. You are being assessed. And that goes back to your question.
I think that's it.
I have
Thank
a
you.
question. One last question. Can you talk about, when you hint on the implosion, right? There's way too many hedge funds out there. And a lot of them are managing many, many billions of dollars. As you know, right, when the asset gets bigger and bigger, the return goes low and lower. Like, when you talk about the implosion of hedge funds, what do you see? Like, do you see the bigger hedge fund getting broken up? Like, do you see the mid-tier, the high performance truly come out of this whole implosion?
Yeah, so before the correction is what I call it. I don't call it an implosion per se. I call it a correction. Before the correction, what would happen is it was free money. So you had startups that were raising with $1 billion on day one with an analyst who'd actually never run money before, but because he came out of a fund that you read about, people would just give him money for 4 years locked up. You had a bunch of $4 or $5 billion funds putting up 5%, but they were okay, and the big were there doing their thing. But after 8 years of the overall asset class not performing, people are wising up. And you see names like Valiant, okay, which was a manifestation of the issue in the industry, where all the smart money sat in that. And because they were just getting their returns, there's no analysis, nothing original happening. And you have a downturn like you did in that period of time, and everybody was in it, that was a bad referendum on the industry. And to me, that was a very important point when you look at the history of hedge funds, will be Valiant in the recent past. And so to get to your point, what we are seeing now is a barbell. We are seeing the big get bigger, the ones that everyone here knows about, but what they're having to do, because as you said, they get too big, is they're launching a new product to whatever's du jour. They can do that because they have 20, 30, 40 billion dollars under management. So what's hot right now? Let's launch that product. They'll hire a PM to do that. And that's where a lot of the talent is being forced to go. But that's not for every investor. So the reallocation of capital has to go to that sweet spot of people who are playing in names that you would not be able to do the analysis for yourself and get through an ETF and provide that return that we're talking about. That's going to be the future of hedge funds. You have to be in that area, small enough, nimble enough to get the returns that they used to do.
I mean, that's actually the true form of hedge fund.
That's exactly.
Going back to the original form.
Right.
And those hedge funds are competing with the very people that'll be here tomorrow for your capital.
Right, it's a nuclear winter, and now the cockroaches are going to come in. And we'll have evolution all over again. I think that's a very appropriate place to end on hedge funds.
It's healthy for winter to come now, isn't it? All right, Omeed, Joe, thank you guys very
Thank
much.
you very
Please,
much.
round of applause.